Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. Kansas City wheat. The key patterns here for many months now have been the late March to late June diamond pattern and the extension of its lower uptrend, highlighted in bright green on my daily chart, and the larger big inverted roof pattern, sometimes called a half diamond, which is highlighted in purple on my daily chart. Prices managed to reach the primary target of the first diamond pattern type, but failed to make it to the harder to reach secondary target. In early August, the market punched down through the purple uptrend of the inverted roof pattern and has headed lower ever since. So where does that leave us now? I said when the move lower started, and I quote, "A primary target X2 for the inverted roof stroke half diamond pattern will be down in the 733 zone, with a secondary harder to reach target X3 down at 646. This is only the first few days of this move lower, so it could still be a false break, but those are the potentials for such a pattern as this inverted roof pattern." End of quote. The move lower now, obviously not a false break. The move lower reached the primary target in the 733 zone in late August, with the market continuing lower as recently as last week. This move lower over the past 3 weeks broke down through some interesting supports that are now resistances, specifically the big 50% Fibonacci line at 697, the absolute Fibonacci line at 697, and the 50% Fibonacci line of 2011 to 2019 move at 691. However, this week has been a week of primarily hesitation and some small recovery, notably today, over the 50% Fibonacci line at 691. As I said last week, and I quote, "We are seeing the market edge ever closer towards target X3, but it is still a cautious move lower." End of quote. The one potential new feature is to regard the action since August as a possible descending expanding wedge pattern, currently 638 to 717. This would not be the best example of such a pattern, but it does hold some merit. For the moment, I've chosen not to highlight this pattern, but just to observe it. Minneapolis wheat. Compared to Chicago wheat and Kansas City wheat, Minneapolis wheat had been somewhat easier to read in recent times with respect to what was going on and what the opportunities might be. This is no longer necessarily so. In late February and especially at the start of April, the market constructed a large bear channel that morphed into what we see highlighted in dark blue on my daily chart, which is a descending expanding wedge pattern, currently 820 to off the bottom of my daily chart. This originated from December last year, but really became evident from February this year. The upward trend line has been previously reinforced, sort of, by the declining medium moving average, currently 815, which combined together to help cap the market in very early April, then mid-April, mid-May, and mid to late June. However, mid-July, the attempts higher resulted in a clear break above the upper trend line, and also the important declining long moving average, currently 841. Prices climbed rapidly up to the 50% Fibonacci line, the significant August 2020 to May 2022 move at 955, where the rally petered out and turned back down. It is this turn back down that has captured my attention, as the market has since late July till mid-September formed a descending scallop pattern. Not only that, but since mid-September to have seen the market form the ski bump of the descending scallop pattern, and since the start of October start on its journey lower to potential targets for such a pattern below. Thus a primary target for such a pattern would be in the 708 zone, with a secondary harder to reach target X1 in the 689 zone. Last week, to be honest, apart from the May 2021 low at 676, we didn't seem to have that much support below. However, the June 2021 low at 737 seems to have been and done enough to at least cause a reflex rally back upwards, such that we are once again testing the May low at 769. As to whether we may carry on higher, on that I'm not certain, as the ammunition gathered during October does not look that substantial. Hence I would pay attention to the May low, the July 2021 low at 778, the descending short medium moving average, currently 781, and especially to the upper trend line, currently 787, of the nascent late August to date bear channel. I have not highlighted this last one as I am unsure of it at the moment, but you can clearly see it on my daily chart. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.